Hey guys, Nels Larson, CPA Guidance Accounting. Just wanted to share a conversation I have, probably a couple times or once every 2 to 3 weeks, because it seems to be a popular one. It has to do with how flow-thru or pass-through entities are taxed, and specifically I'm talking about small business owners. Oftentimes it's somebody who even has owned a business for years, and they'll think that the business owes tax when they file the business tax return. And that's not really the case. So, what I'm talking about are S corporations, partnerships, sole proprietors, and then LLCs that are actually taxed as any of those three. So let's start with sole proprietors. So, sole proprietor is somebody does not set up a separate legal entity. They're just doing business as Joe Doe or Jane Doe, landscaping, whatever the company might be. So there's no Inc., there's no LLC at the end of their business name. And what happens for tax purposes, for income tax purposes, is that person is just picking up the reporting their income and expenses and taxable income just gets reported on Schedule C of their personal tax return. So that's a sole proprietor. But there, the business doesn't owe tax, it's the individual. And with an LLC, LLCs actually are kind of weird because the IRS never really figured out how it wanted them to be taxed. And so LLCs, if there's just one owner, they get treated like a sole proprietor for income tax reporting purposes. If there are two or more owners, they can be an S corp or they can be a partnership. Let me amend my earlier statement. One person owning an LLC can choose to be taxed as an S corporation. S corporations and partnerships actually file a separate business income tax return with the IRS and their state Department of Revenue. And then they get a K-1 from that business income tax return. And that K-1 shows their profit or loss from the business. And they take that K-1 and the numbers reported on it, and then they drop those numbers onto their personal return. So the income tax that is going to be as a result of the profitability or lack thereof of a partnership or an S corp are actually going to be paid on the individual partners or individual shareholders' personal tax returns, income tax returns. So it seems like there's a lot of confusion in this arena. I don't know if this helps at all, but we'll pretend it does and keep plowing forward. Thanks.